And I think we are live, guys. Let me just double confirm.
Doesn't show. This live video should start soon. Not yet.
You're live.
Okay. Hi, good evening, guys. Good evening, everyone. Maybe I'll just give 1 or 2 more minutes, just for everyone to come in first.
Hi, Viva. We have Viva here. Poster still in the middle. Viva T. You guys are awesome.
Yep.
Hi, Thomas. Good evening, Kok Wei. Guys, can you see the comment on the right side?
Yeah, we can see the comment.
Good evening, Kikiet. Hi, Kok Wei. Hi, Jinkai.
Hi, good morning. Good evening, guys.
I think today's discussion will be very interesting because we are going to talk about our performance in year 2020, as well as our stock pick for the next year. So I don't know, I feel a bit nervous, because this year my performance compared to other investors underperformed seriously, man. So yeah.
You're not alone. You're not alone.
Oh, is it?
Yeah.
I don't know whether I should feel happy or what, but yeah. So I think Rondy, Rondy's screen is a bit stuck. I think most of the people in StockBit know Rondy, but maybe Warren and David. Even today is the first day I meet you. So Rondy, how do you want to start this dialogue?
Yeah, so
start with introduction or something.
Yeah, so I think I would like to get this dialogue a little bit more organized in the sense that we let's try and do things by topics. Maybe just for a start, let's do a round of introduction about ourselves. So maybe I'll start first, yeah, and then we'll go to Warren and then David and Meng Teck. So yeah, again, good evening, everyone. Thanks for being here tonight with us. So myself, Rondy, and you guys perhaps you all know my platform, right? It's StockBit. So what StockBit does is it's actually a platform. It's a social networking platform where people can come and learn, discuss, and find information about stocks, about Bursa Malaysia stocks. And I think this year especially we have a growing and a healthy community, and everything in StockBit is free. All the features that you see in StockBit is free. And for StockBit, our goal has always been to bridge and to narrow the information gap for retail investors, so they can make the best investment decision making. So please, go ahead and download the app, or you can just create your user by just visiting the app. Sorry, the web, www.stockbit.com. And just on that, before I pass it on to Warren, StockBit is also currently having this competition. It's stock picking competition for 2021. There are some cash prizes as well as some StockBit goodies for grab. So just join StockBit and join the competition. Yeah. Okay. Maybe Warren. Let's get the dice moving to you.
Sure. Thank you, Rondy. Yeah. So my name is Warren. Very nice to meet you guys. Good evening, by the way. Thank you for taking your time, to spend this for to listen to the live. I'm a founder of Academy. We are poised to empower people to grow portfolios through investing and trading stocks. Right. I founded this with my partner Shafiq. Basically, he concentrates on trading, and I concentrate on growth investing. Right. We're mainly focused on US growth investing, but not limited to US, of course. And we also emphasize a lot on portfolio management. Yeah, so it's just the two of us running the academy.
Very interesting. Yeah.
Yeah.
Thank you. David,
Okay, so
maybe.
I guess it's my turn. My name is David. I am the founder of the Spiral Thinker Group. So, like Warren, we do provide educational services, although it is not our core. Our course is called Intelligent Value Investing, where, like Warren from Paca Academy as well, we focus a lot on portfolio management because we believe that stock pick is just at most one third of the story, and the other one third is actually very much on how you manage your portfolio. We focus a lot on fundamental analysis, where we do a top-down analysis using we look at the qualitative of the side of the business. Then after that, we do a bottom-up stock pick. So that's our strategy. So I guess for a good part of 2020, due to the pandemic, we have suspended all our courses. But we continued. Actually, we doubled down on our monthly club meeting with our members. So hopefully, 2021, we will open up our members, our club or our networking group to the public. So please stay tuned. Yeah. So again, thanks to Rondy as well as Meng for inviting me to this platform tonight. Yeah. Meng, over to you.
Interesting, David. That you stopped the classes. Why? I'm wondering why you don't want to do it online. But maybe later you can share. Maybe you have a different kind of philosophy. So, hi everyone. My name is Meng. Thomas asked whether I just woke up. The answer is no. But I kind of rushed home. I was in the hospital just now with my dad. It's been a crazy week, right? And what I do is in my company, Savvy Investment. We have been teaching investing for a long time, 6-7 years. But this year we actually started, our own membership, our club as well, where we share what's our stock pick and etc. And yeah, in fact, last Saturday, I just did a 2020 review and also 2021 stock pick, which is gonna be the topic for today as well. And I can't wait to hear what Warren, Rondy, and David has to share. Thank you for all the good wishes. Yeah, and I want to learn about. And in fact, one of the stock they will be sharing is very interesting to me. So yeah, Rondy, over back to you.
Okay, so I guess before we move on to the real meat of this particular discussion today, maybe do you guys have anything that you guys want to share with regards to the year 2020? I mean, all of us know that it has been like a roller coaster year, an unprecedented year, right? But in terms of like stock investment, stock trading, is there any like key takeaway that you guys want to share to the market? Like, what's your biggest learning curve this year, especially?
Maybe I can start first because it's still fresh in my head. No, actually, this year has been a torture for me. Every time I see the share price flying up like 5-10%, it's been a torture because I've been playing it too careful. That said, actually, my performance for the whole year on the entire portfolio, because I keep adding capital, should be about 30 to 40%. I can't be sure because I only start measuring with all the capital in since June, but I'm partially invested. I'm always waiting, let's go in tranches, but the share price keeps shooting up. So later I'll share with you some of the US stock that I picked, which if I bought in the time I analyzed them, easily 300% return. CrowdStrike, C Limited, Square, right? But the problem was, it's a bit too high now. It's a bit too high now. And then they get higher and higher and higher, right? So that is my biggest learning for this year. And I guess, right, if there's another crisis, the biggest lesson that I'll be doing is the moment they announce, unlimited QE, low interest, very low interest rate, that's when you just go all in. You don't think a day, just all in. Don't, think this, think that, nothing can fight the Fed. Yeah. So that will be my biggest sharing for this year. So, listening to all the news and then anticipating all these things is really a waste of time. So just look at the Fed, what they are doing, and then just be confident with your pick. Yeah, but actually, in fact, we performed quite okay with all things considered, just under invested only. But our pick are, doing very well.
Nice.
Yeah.
Warren,
So
what about you?
Yeah, sure. Let me start with mine. It's funny that you mentioned, Ming, that you said that it's tiring to look at news and anticipate the trends. I do agree with that. Actually, it's very tiring, lah. So that is a strategy more to trading and momentum, which my partner emphasizes. But overall, in 2020, seriously, those who are invested and know how to invest, I think they would have an awesome year.
Yeah.
Because, because me personally, sad to say, like, out there got COVID cases and all that is really sad. But to be frank, like, my personal net worth, my personal portfolio, it has been quite awesome, lah. I would say quite awesome. I'm really glad and blessed, lah, actually. So I started a public account, what I call a public account that I can just reveal to public and all that. And I'm fortunate to see that it has grown 400% this year. So that is 400%. I'm really blessed, So the thing I learned about stock market in this year is that with that huge downfall, the massive liquidation in March, the recovery is like fast, like crazy
I've
fast.
never seen. Yeah.
So the stock market is always like that. It's always prices in the fundamentals earlier than expected. So that is what we can actually gain off in moving forward 2021 in a way. With so many people in the market, the stock market is like a casino. Some people are treating it like that way, so we have to be careful, right? We also have to know that fundamentals will have to last, right? And it's very important when it comes to investing. And the shift in paradigm, right, from value investing, it confused a lot of value investors, right? So it validates the fact that stay-at-home growth stocks actually work, right? Stocks like Dropbox, stocks like Square, you got a lot of growth stocks in the US also. So that validates that in 2020, and I believe 2021 also, which later we'll be covering on that. Yeah. So yeah, I mean that is the overall concept of 2020 that I've gone through. Yeah. What do you think, David? I mean,
Yeah, I actually agree with most of you guys. Whether 2020 is a good or bad year, right, depends on which month you're looking at. I guess during the first quarter, everyone is feeling the same pinch, right? I do agree a lot with Mentech. Actually, the reason why the stock market went up is not really because of real growth or real recovery. It's really just because of liquidity. And when central banks like the Fed start pumping unlimited quantitative hot money into the market, right, assets are, they tend to go up. So our biggest lesson in 2020 for us at Spiral Thinker, actually we have two big ones. Now the first one is always about, and it is a try and true saying that every crisis there's an opportunity. Now, I don't mind sharing with you that during the first quarter we got hit really bad with AirAsia. As you know, if you've been following the Spiral Thinker, you know that we are a firm believer of the low-cost carrier business model. That's why we have been always, singing good tune about AirAsia since the beginning, since we started the Spiral Thinker group. And for all the wrong reasons, airlines is one of the sectors that was hit the most during the pandemic. So during the first quarter, we were hit very, very badly, and we had no choice but to cut our losses. But with this crisis, there's an opportunity in healthcare, particularly the glove stocks. So the glove stocks, we actually allocated a lot into the four major ones: Top Glove, Lega, Supermax, as well as Kosan, and it helped us, boost our performance from the bottom to the close of the year. I mean, I'm looking at the bottom, right? Because we manage quite a few number of portfolios. The best portfolio is doing about 40% per annum. To us, value investors is fantastic because we are only looking at 15% per annum. No? Not like if you want to go for 400, you better follow Warren, right? If you are like the more boring type value investing, yeah, you can come to us. Yeah, so that's the first lesson that just to repeat, every crisis is an opportunity. The second one, which is actually even more important, is actually all about allocation. Now, we believe in the end, right, how you structure your portfolio is more important than your stock picks. Now, just now, Warren talked a lot about growth stocks. Now, I totally agree with him. But in the way we manage our own portfolios, right? We normally divide it into 2 or 3 buckets. Now, the first bucket is usually the value stocks, the boring kind of stocks like Nestle, the telcos, the utilities. It's day in, day out, they'll be there. They're not super high growth, but fundamentally they're very strong. Now, then the second bucket is where you put all your sexy stocks like the growth stocks, the high growth, the technology stocks, the like the internet platform, the big tech stocks, so on and so forth. Then you can have another bucket if you choose to have it, a small one compared relatively to the other two, for speculative or for short-term trades. So how you structure your portfolio allocation to us, this is our main takeaway for 2020. Yeah, over to you, Rondy. What's your biggest takeaway for 2020?
Yeah. Okay. I think for me personally, this year has been also relatively a good year. I would actually say it's actually the best year of my investment journey, as a matter of fact. I also have, I would say, about a triple-digit return in terms of percentage. But
Congratulations.
yeah, but putting aside like percentage returns and stuff like that, I think this year is a year where there has never been a better conviction for myself that on 3 things. Perhaps the first one is that the big money is made on holding, not really on like a buying and selling on a regular basis. Perhaps that's just for me because I'm not really a good trader, but you know. And secondly, I will also say that what we need to do and what we really need to see is that we should always focus on business quality and don't really obsess over valuation. Yes, of course, sometimes people there are, I think, like David mentioned, some sort of value investment and all that. Yes, those are important as well. So valuation is definitely important, but I think what is more important than valuation is to focus on the quality of a business, such as the balance sheet. This year, especially if, for instance, you have a strong balance sheet, you can easily ride the downturn in March, right? And growth prospects as well as the capability of a management team. So these are more important, in my opinion, rather than valuation. And lastly, what I also want to say is that what I learned this year is that in stock market and investment, you can never do it alone. And I definitely know because, of course, I run StockBit. In StockBit in itself, there has been so many trade ideas that comes from within that particular StockBit community. Now, StockBit has been around in the market in Malaysia for about around 2 years now, and we have about close to 40,000 to 50,000 users in StockBit. And what happened this year is that I have been able to leverage on other people's ideas, other people's knowledge and experiences, and the community in itself, it presents and it enables us to view some sort of like your point of view from a variety of angles, right? Because there is not like one right and one wrong. Yes, you have to be objective in terms of your decision making, but you can always take in a lot of different views for you to have a more holistic and a better decision making in terms of your investment. So I believe that the power of community is great. For basically, it compounds the sharpness of your learning curve, and therefore I also believe that sharing is caring. Sometimes people are always asking me, why are you sharing things in StockBit for free? And I believe also in a sense that this year in itself, from the way the retail market works and how the retail market really kind of like boosts the stock market in Malaysia up, right? There is this thing what we call as the network effect. So yeah, 3 things that I learned this year is that number 1, the big money for me personally is made on the holding, not in the buying and selling. Number 2 is that we should focus on business quality and don't really obsess over valuation. And lastly is that you can never do it alone. You should always have a community that helps you to in this particular investment and trading journey. Yeah.
Yeah, I agree on the community part. One of my best idea for the year, NTPM, came from StockBit. Some users were discussing it, and I saw it. Hey, it makes a lot of sense to me. Previously I wouldn't look at it, right? The
Yeah.
numbers look terrible, loss making, downtrend, everything, but the story checks out. So yeah, that's why I bought in and went to the AGM to confirm further. Yeah, but again, if to add to Rondy's point of view, I think the market has evolved a little bit this year, where I think the information age is really getting closer. One of the reasons why Rondy came to Malaysia to start StockBit, when he told me, I believe it's the same now, is to close the gap between institution investor and retail investors. I mean, retail investors are people like me and you, and institution investor are people like maybe the research house, all this. Why do I say it's important? Like stocks like NTPM, yeah, on the surface, we can have an analysis from the outside point of view and see the correlation between the stock price as well as the share price. But you can only remove all the guesswork when you are able to meet the management and ask them questions directly. And unfortunately, a lot of the time, we are only able to do it at the AGM itself. So it's a once a year thing. And other times, maybe the share price is moving up, but we don't know why. Maybe the share price is moving down, but we don't know why. Sometimes it may be due to market sentiment, but sometimes there is a legit reason. But normal shareholders out there that may not have enough information, may not be aware, and you may not be able to make the investment decision as good as you could if you have had those information. So in a way, I don't think Malaysia information wise is very fair, fairly distributed to the retail investor. So there is a gap to be closed there, and I personally benefited from this a lot this year from all the connections I know and being able to attend EGM and investor briefing. So that really helps in my investment. That's why now I'm like way more confident with my stock pick.
Mm-hmm. Yeah, I think especially this year when both of us, right, Meng, when we talk to management, these are also, these are not something that is easily accessible before this year, I would believe, all this speaking to management and getting insights from them and all that. It's definitely because of the digital era, I believe, and also because of the power of the retail investors, an evolution in the stock market, as you mentioned.
Yeah, I think it has happened and it's here to stay.
Okay, so maybe let's move on to the next topic, right? To the real meat of this particular conversation is basically on everyone's strategy for 2021, which I believe is quite insane, right? Because for instance, in March, I believe Meng and I, we had also like a Facebook Live, and the question that was always asked is that where is the bottom? Can we start investing now? But now on the 30th of December, going into like 2021, your S&P 500 is all-time high. Alternate asset classes like Bitcoin is all-time high, and all this sort of thing, which gives you like which makes you wonder whether is the market actually overheated? Are we in a bubble, or on the contrary, in that do you need to be invested and stay invested because the interest rate is low? What's your opinion on this, guys?
Yeah, Warren, maybe you can start first.
Yeah, sure, maybe I'll go first. I mean, I also saw a comment from Sing Choi, exactly the same as what you asked, Rondy, is that are we into a bubble, or with the cases growing more and more, is it going to be worse? My personal opinion, and I could be wrong, right? First of all, is that no one knows, seriously, no one knows of the outlook of 2021 in terms of the recovery from vaccine or recovery from COVID, right? No one knows. So it is always best, I would say, because of interest rates being low, we got nowhere to park our funds. If we park our funds in FD, it'll be eaten by inflation. It doesn't make sense, right? So this creates a lot of opportunities, lah, right? Even when it comes to stocks, right? That is why the property home prices are growing at 19% year on year in 2020 in the US, lah, US. And this gives opportunities in stocks already, right? We got Redfin, we got Zillow, we got Open Door, and all that. That being said, right, valuations are off the roof, in my opinion, for tech stocks, because the stay-at-home growth stocks have been benefiting from COVID, right, 2020. In my point of view, the valuations are stretched. But then comes to play where we also can diversify, right? We can diversify to recovery stocks. Not all in, obviously, right? So we got to diversify to all these stocks, growth stocks. We have to have our hands on these companies. So recovery plays should be restaurants like Cheesecake Factory, for example. I focus on US, sorry. Because most of my time is spent more on US growth. So yeah, I mean, those that are really beaten down in 2020 that have been losing earnings, right? There could be, I mean, we have to face the fact. 2020, we expected vaccines to be out in 2021 but December, like this month, is already on a rollout already, right? Pfizer, Moderna having like few million vaccine. The only problem is that logically, if you ask me if I was to give a vaccine to my daughter, I'll say hell no, lah. Simply because it's not tested yet, right? But people are looking at another way. I got a friend in US, he already got vaccinated, even if he didn't have COVID, but he got vaccinated. So what I'm trying to say is that there's a mixture, but we still have to be invested, right? Because of the choices we have in the market, right? Putting our money safely doesn't really work, okay? And this is where we have to take opportunity to mix strategies where we trade and we invest also to maximize the portfolio. So other than stay-at-home stocks, right? We got recovery stocks, and I'm very bullish on EV. Right, EV. I mean, seriously, EV is here to stay, right? For a decade, even not only 2021, to be frank. Solar, right? Especially with the Biden taking over control. Cannabis, right? These are growth potentials that I strongly believe, Yeah. Property in Malaysia, especially, I'm quite bullish on property. By the way, I'm in a property background, right? So I know a little bit about that, right? Developer, contractor, right? So I'm quite bullish on property per se, but more to residential housing, focusing on more to have residential houses rather than commercial, right? So developers like Legenda will probably benefit, in my opinion, right? Yeah. So, but we have to be very solid and clear that. In 2020, SPACs. You guys know SPACs, right? Special purpose acquisition companies. These were hot. Like they have 2 years to solid a merger with a particular company. For example, like SBE having a merger with ChargePoint, and people were still so-called goring the stock, but when people gain, they'll be thinking, "Hey, shit, I'm damn smart. Yeah, I'm gaining 100% in 2 weeks." That mentality we have to change, because we have to really ask ourselves, like, not only on valuations but the growth prospect. Of course, the growth prospect is high, but whether does it make sense for us to, the fundamentals buy and hold will actually determine whether or not it's good to buy now and how long to hold, right? So we have to take this in mind, yeah. Other than that, I would say we have to be cautious, right? Portfolio management is everything. I agree with David, that portfolio management is everything. We have to know how to segregate our in sectors or holdings, our position sizing, right? And it's more to risk management, right? Even if you're trading, your risk management should be less than 5% of our portfolio, or 2% every 1% every trade, right? All these sort of things. So yeah, I would say be mindful of all these, and don't be too drowned in easy money making. Like, the stock market is not about fast making money. It's about buy and hold works, right? Like what Rondy said earlier. That's where the huge meat comes in, right? So yeah, overall, I'm bullish on EV, energy related, stay-at-home stocks, property. yeah, these are the companies that I would be tuning in 2021 and beyond. Yeah.
Yeah, I would like to echo what Warren said. It's not a luxury, not it's no more a choice whether we want to invest or not. I think it is a because of the low interest rate regime, right? We have no choice but to invest, continuously invest. But how we deploy our capital into the market, now that is the golden formula that you and I have to find out on our own. There's no one magic formula or magic strategy that we can use. In fact, if there is, then a lot of people would be very rich right now.
True.
Yeah, and at the end of the day, try not to focus too much or obsess too much on the performance. But as what Warren said, right, focus on your risk management first. Because as long as you don't lose money, right, eventually you make money. Trust me, we have most of us have been there. Yeah. So to come back to the topic, 2021. Again, I like to echo what Rondy and Warren said, right. At Spiral Thinker, our core competency, our circle of our COC, right, has always been technology. And we believe that 2021 and beyond, right, is really, really the start of a super cycle, the next super cycle for technology stocks. Now, I would like to clarify that when we talk about technology, we are not referring to the big techs, the big tech, the big techs like Amazon, Alibaba, Tencent, Sea, Now, those are great, but those are mostly platform companies. What we focus more at Spiral Thinker at the moment are the semiconductor companies, as well as the supply chain. So I think in Malaysia, you guys should be very familiar with the OSAT players, the ATE, or even the EMS, right? Okay. And our investment thesis actually stems on the with 5G has just started. In fact, because I come from technology, I come from a telecommunications background. So I do understand a fair bit about the 5G technology, and trust me, we have not even seen the strength or the what 5G can do, for us. So and 5G is not the end. It is actually a means to a lot of ends. I'm not sure if I can share my screen with you guys. Hopefully, it's okay. I just share with you one of the slides that I used to share. Okay, this is a slide I use in I think one of our internal club meetings with our members. I hope you can see. Can you guys see the screen?
Yeah, I think you need to bring it up back again, Shafiq.
Yeah, is it all right? Cool. So now, as you can see on the left-hand side, you look at future trends, right? So these are the main, not the only one, but the main future trends that we are looking at. And we have things like IoT, artificial intelligence, autonomous vehicle, EVs, so on and so forth, right? For these to take off, 5G has to be there. Now, you imagine 5G like it is the infrastructure for all these future trends to take off. Now, in layman's term, imagine 5G like a highway. Before you can, drive your supercars like your Ferraris or your big trucks on the road, right? The infrastructure has to be laid down properly first. No, then imagine these cars or these vehicles on the road are your business case, or your other technologies, be it EVs or autonomous vehicle, IoT, because this will require a lot of bandwidth. That's one, and secondly, it is the latency. Where you're talking about internet medical, where you can do remote surgery, right? This is where this latency plays a big role. And the current technology like 4G, they can't meet this. Only 5G and beyond can do this, right? Now, again, I'd like to echo what Warren said. To us, the EV is just taking off, and we have not really seen the big wave yet. The big wave is definitely going to come. Autonomous driving will not, just happen like that. It will take time, but along the way, because transportation is a very traditional, I would say, sector, right, business, and it is bound to be, disrupted. When Elon Musk first spoke about, electrifying cars, right, people are laughing at him. So look at where he is today, right? And I think we have yet to see a lot of things, good things coming on for electrifying the vehicles. all the way to level 4, level 5 autonomous driving. But along the way, of course, if you can look at the right hand side, so this is a report by Deloitte, right? So other than EVs, we can also look at the Internet of Things, where smart devices like your smartwatch, or your Google Glass, so on and so forth, head-mounted displays, and other industrial electronics, automation, Industry 4.0 is the next big thing that we'll be looking at. Yeah. So over at Spiral Thinker, we are a big believer in this technology super cycle, right? So then other than this, for 2021, we are also looking at some cyclical plays. So one of the other cyclical play is, we believe that food security is going to be very crucial in the future. And that's why you see countries like China has been stocking up a lot on strategic food resources over the past couple of months, right? And the other big theme that we are looking at is actually ESG, which stands for environmental, social, and governance. Yeah, so it's a very big topic. I don't want to hog the limelight too much by venturing into the ESG theme right now. Hopefully, Rondy will ask me back after tonight, right, to really look into this topic again. Yeah. So that's what I have to share for my side. Again, just recap, we are very bullish. We are very confident that the technology super cycle is just beginning. Yeah. Over to you, Teck.
Yeah, I agree. The other day when talking about EV, right? I personally never buy into Tesla. I agree with all the points Rondy say, but I'm really not comfortable buying something, not being able to estimate what will be their future profit, even 3 year, 5 year down the road. I'm okay buying CrowdStrike, Say Limited, all this, because I can see their EBITDA is being hidden by advertising costs and they're trying to scale. I can see the potential where they will be 5 years, but Tesla is just a bit not able to imagine for me. But one of the company in Malaysia actually quietly is able to benefit super big way from this EV called Teck. I just found out they are doing the socket for the electric charging for Panasonic, which will be all the non-Tesla car charging station. It's using that. So no wonder the share price has been riding up so much. But again, being the cheapo that I am, I'm waiting for retracement before buying. So yeah, so we are talking about 2021 strategy, right? I think everybody has a core team, but for me, I don't really have a core team. I have many, but I really like what Warren and David shared just now, because I am also invested in cannabis, but not in a big way. But I picked, I think, the most quality company in cannabis. So I usually don't go big into one sector. I find in one sector what is the best, and I buy that, right? So there will be probably 5 to 10% of the allocation, and I go in batches. So maybe 2-3% initially. Then if it drop more or if it goes up more, another 3%, another 3%. And interesting, I finally found one person who have the same idea with me, which is property market is about to run. I mean, you are the only one that I've seen so far that agree with this idea that property market is about to recover. Everyone else don't think so. But I think there's a lot of points to support that. In fact, I just bought in more property shares. In fact, I just entered my property investment during my birthday, which is like a few days ago. And today as well, I added even more shares to a property counter. Just imagine, like steel counters are all running up, steel price is going up, right? The property is made from steel and cement and all this. So naturally, home prices should go up, especially the future home prices, because now it costs more, right? So that may, and with the low interest rate home ownership program, may create another speculation bull run, something in the property market. And if you are only going in when everybody is chasing, just like the glove stocks, you go in August, it may be a bit late. So yeah, now you want to buy when nobody agree with you. So that's why I'm already starting to scale into some property counter right now itself. But a big percentage of my portfolio, in fact, about 25%, thinking to scale it to 30%, is in one particular stock, which is overseas in Cambodia, but listed in Hong Kong, which is a casino, right? It's the most well managed. The numbers are like, if you're a valid investor, you look at the numbers, you like, wow, saliva come out, those kind of thing. And a monopoly license, super fast growth, right? And yet very cheap. So value growth. I don't really care what sector, as long as it's value growth, I can see, compared to the price, the valuation, the growth, exciting growth, valuation fair, that's what I'll pick. So topic will be casino for recovery, right? Because even before the vaccine is out, they are already now making 90% of pre-COVID earning. After vaccine is out, I can't imagine where they'll be, right? And the share price is still way depressed. Unlike Malaysia one, a lot has already recovered, even before showing any real sign of recovery in the business itself. So that's one. Number two, banking. I was bullish on the bank in US, but unfortunately, I did it via sell put. The share price went up way too fast before I was able to catch it, but I made some money, 10-20% there. In short, a lot of the share price has been going up way too fast and way too early than expected. I don't know what will be happening next year. And this one, property is my second most bullish one. In the meantime, I'm also holding some mid-term investment on oil and gas, because all these are something that I will let go with a 50 to 100% gain. Oil and gas, NTPM, these are mid-term trades, right? But for long-term wise, I'm into the casino, which I think, even after COVID, because this casino has been growing. It's a 10-bagger in the past 10 years, and I believe it will be another 10-bagger in the next 10 years. Then number two is the property. This one will be maybe 5-year play, right? Because this is a super cycle. So I believe we are at the bottom now. I'll be surprised if it gets worse. And then after that, I'm also very, very happy because I told you guys, right, I actually miss out on a lot of like good stocks. I know how to identify them and I bought them, but not in a big amount. But recently, Facebook and Baba, regulation come and catch out them. That's my opportunity. In fact, I've already made some good profit from buying Facebook and Alibaba recently. And also, today and last week itself, I added a little bit of share into a Poland company called CDR, right? They are the company that make Witcher 3 and Cyberpunk. Yeah, I also believe that the sell down is a bit overdone. So also bought in a bit. And yeah, so that will be my holding for the next year. It's a bit more ideal because it has more tech stocks and growth stocks than trading one. So I believe my portfolio now is positioned for a balanced growth next year. Even if vaccine is not out, then the tech stocks, the growth stocks will help me drive the return. If the vaccine is out, then my property stocks and the casino stock will drive the return, which I don't think, Baba and Facebook, whether vaccine out, whether vaccine not out, will be affected. They will still be good. In fact, Facebook is one of my most bullish pick now, right? Just that I haven't been able to scale in very big yet. I'm going in stages. Because why? Facebook has just released 2 features, which I think these 2 features can double their earnings in the next 3 years. But it's underreported now. Nobody is talking about them or what. They just added Facebook stars. I wonder if you can, send us stars on Facebook now. If you can, you try, right? And Facebook fans, right? Both of these are very huge thing in China when people do like live streaming, right? And it's generating super crazy high revenue for those platforms. And Facebook just introduced it, right? And now it's beta mode. And whatever earning you get from the, subscription service or from the stars that, you send us, Facebook is going to get 30%. So I see that as super huge potential, as big as their ad revenue part. Yeah, so that's my sharing, right? For the next year pick and where I see we go next year. But I'm very curious, what do you guys think about all the tech stocks that ran up so much this year due to the pandemic? There is a story, right? Yes, they are indeed good stock and they have grown like 80 to 100% in terms of the revenue. The whole thing changed for them. They will, people use them more, get a lot of users like Zoom, C Limited, CrowdStrike, all this. Do you guys think that next year, despite having all this growth, there may be some sell down because all this growth has been priced in and in fact a bit overpriced now. What do you think?
Okay, so I think I'll answer to your question first, Meng, take on that. But perhaps before that, I just would like to address my personal stance. Currently, I'm just looking into like my personal portfolio going into the new year. I think I have done a pretty good rebalancing in my opinion. But in terms of, I think you guys touched on a lot of sectoral positions. Yes, I have. When I'm looking into this, and if let's say I would categorize them in terms of value against growth, against like defensive and high yielding stocks and all that. I think currently I'm quite balanced in the sense that I am 60% on growth stocks, so called, 30% on value stocks, and I would say about 10% on like super defensive, high yielding stocks, like your super boring kind of like REIT kind of thing, you know. And on top of that, currently I'm also at a portion of about 62 and 38% equity versus cash ratio. I would like to hear about what you guys think in terms of cash to equity ratio on your positions as well. But yeah, on one side, I do agree that everything feels a little bit toppish. But on the other side, you know, I'm definitely leaning more towards that you have to invest, as David mentioned just now, because it just doesn't make sense if you do not invest, right? Because the interest rate is just so low. And on that, I also would like to touch on there was this kind of like a discussion I had last week with someone on basically valuation against interest rates, and basically what we mentioned as earnings yield. So you know how previously in Malaysia and even where I came from, Indonesia, and even in the US, you know, when you have a relatively higher interest rate, what a PE valuation of 30 could be expensive. But right now, if let's say, you know, a PE of 30 is equivalent to an earnings yield of about 3.33%. And when you are looking into like your treasury yield or US interest rates at zero, or let's just say 10 years treasury yield is barely making any percentage return, 3.33% of earnings yield is extremely cheap, right? It's extremely good in terms of yield. And therefore, PE of 30 or even PE of 50 right now, it has a different weightage right now than what it was 2 to 3 years ago. I think that is something that I would like to share to everyone, to the audience now. And yeah, coming back to the sectoral, if I'm looking into my shares, I do have some properties. I still have some rubber glove. I mean, I don't know. Right now, rubber glove feels like a value to me. And if let's say you are a fundamentalist, you cannot ignore the glove lah. Maybe you can always pick which glove counters that you would like to go for. You know, I mean, I would like to hear all of your opinions about glove later, okay? But yeah, there are, I feel like in terms of sectoral, I still have my Tesla. My Tesla is still my main holding, even though I've been trimming them.
Man.
Yeah, even though I've been trimming it like every day. And then of course Facebook I still have. So a lot of tech stocks still. I have rubber glove. I have some value consumer. I have recovery tech stocks as well, like Walt Disney and Booking.com. I still have those things. Furniture play, I do have some commodities play as well. Yeah, I feel like my portfolio is relatively not so much focused on sectoral basis, but perhaps more on the company and the business itself. Yeah, I do have some petrochemical. I think next year should be kind of like a top up cycle for petrochemical players. I have some oil and gas as well, and some CPO counters as well, and banks, of course. And yeah, gaming. I think I also have your counter, Teck, so that's good. So
Wow. Good.
yeah, I think perhaps before we move on to the big kind of like big discussion for today, which is your top picks in terms of Bursa Malaysia, right? Maybe I just would like to ask everybody on, you know, the three of you on three things. Number one is I see some questions. What do you guys think of the glove counters and this sector? It's been hot the entire year. But what do you guys think of the glove? Is there still can you still go into the next year? I personally am still pretty bullish on glove, and especially at the current price going into next year, I'm very very happy to bring it into the next year. So that's number one. Number two is what's your kind of like personal cash against equity position, and are you guys invested in other asset classes like gold or Bitcoin or bonds or whatever? And I have the third question, but I can't remember. I lost my train of thoughts. Maybe let's just leave it over there. And yeah, basically, what is in summary, right? If you guys are investing in foreign holdings in terms of stocks, of course, I hear names just now like Facebook, like Naga Corp and all that. But what are your really really top picks, like top 3 to 5 picks in terms of foreign stocks? I think maybe we discuss on this before we move on into like the top picks for Malaysia stocks. Yeah, Warren.
Sorry, just to before I get into that, I just I don't wanna pour water to the fire, lah. But I heard you guys are invested in CDR, isn't it? Because of Cyberpunk. I got friends in the gaming space, and to be frank, it's very bad, lah. Very bad news. You do know that they require higher spec to play the game, isn't it? And they're getting sued by their own investor.
I finished the game.
Okay, good. I'm just giving sort of. You can take it as a warning, or you can ignore it. It's okay. I just want to say it out, lah. It's looking bad in a way until we can see like clear earnings visibility. I think it will be better, lah. That's my opinion, lah. Anyway, I just thought I wanted to share with you guys.
No, I understand, and it's good to share this thing. You know, rather than keeping it, we may miss out, or it's a different point of view. I agree with you. You know, at first I don't want to invest. Because I understand that this is a loss of trust for the gamer, right? And it's based on valuation wise, I don't know why they are trading there. Until I go and read the earnings call, all these things, that's where I see huge potential in the next 3-4 years. They're gonna launch multiplayer game, all this. But the thing is, gamers' perception, would they buy game from them again? That will be a big thing. And they actually, I read the whole earning call, why there is a news that they say the game play well on PS4 and PS4 Pro when it doesn't. Actually, they never say it. It's just in the earnings call. He said it, but the context was taken out of context. So
understood. Yeah, you played the game, so you tried the product, which is amazing, so it's good.
It's super buggy, but I'm confident they'll fix it in 2 months.
Yeah. Okay. So I just want to answer Rondy's questions also. My perception on gloves is that, as being I'm sort of a semi-value, but more to growth, obviously, investor. And it's hard to ignore fundamentals, okay? That's why in part of my picks in portfolio of the year in stock bid, I actually put Top Glove. Simply because their earnings are crazy. You don't get, not to say no Malaysia, but it's one of the top 5 definitely Malaysian companies that is earning more than 2 B a quarter, right? And the orders are still there, right? They have a lot of heat, all right? Obviously from the workers and the US thing not settled yet. But as a value play, I would still be, not to say 100% bullish, but still there. I would have my hands on there. Just to clarify, I don't own any gloves anymore. I benefited a lot in 2020 on the warrants, on the mother companies also. But seeing that trend, because it was meant for a thematic play, and to be frank, it was meant for until December. But everything was speeding up. Like I said just now, everything is priced in earlier. Vaccines are earlier. Everything earlier. Wow. So I just sold off. Right. But I would buy in again next year. And it's really like a few days to next year, right? But yeah, I would buy it again because it's simply very cheap to ignore. Top Glove. That's my view on gloves. Cash versus equity. Like I said, I love to be invested. So, but I also am very wary on portfolio management. So I'm actually 25% cash because I foresee a slight dip, right? The strategy for all plays, not only 2021 or moving forward, should be always buying on dips, right? and I foresee a sort of a slight dip coming the beginning of the year. Although I don't like to make short-term predictions, to be frank, but I just see that because the S&P, like the Santa Claus rally, right? S&P 500, the Nasdaq is all going up already. So I would reserve cash to buy on dips, so that's why I'm 25.75. So moving forward for my foreign picks, my US picks would be Dropbox. I don't want to take up so much time, but few bullish things is because of HelloSign, right? HelloSign is like the brother of DocuSign, where you're signing on virtually already. That will be the new trend. It's a stay-at-home stock, right? They're just having 3% converted users to paying users, but their forward PE is expected to be 25, which is, to me, is crazy. That means it's a stay-at-home stock, beneficiary of COVID anyway. So moving forward, I believe will be still good for Dropbox, right?
That is a subsidiary, is it? You cannot buy the one that you say, the sister of Dropbox, the sister of DocuSign. It's a subsidiary of Dropbox.
Dropbox bought it over. They bought over HelloSign. So that is they acquired it outright. So that's why I'm very, very bullish on Dropbox in that sense. Yeah. Market cap of DocuSign is huge already, right? It's really less than 30 B, not mistaken, right? So that I see potential there, right? So Dropbox, Redfin. Redfin is basically think of the iProperty of US, but they have this difference, the value prop in a way, is that it's called iBuyer. Right, iBuyer is where they sort of guarantee the sale, or they guarantee a buy of people listing their properties. Okay, it's very interesting. This is not new, by the way. This is since 2018 from Redfin. The pioneer of this is Opendoor, right? Opendoor is another very interesting company, right? So it gets me thinking, why isn't iProperty doing this? You imagine a property buying your prices, so people who are listing their houses, right, can immediately get a sale. So I'm bullish on property prices in US for the next year, at least half year. So that's why I will be still continuing holding Redfin, Zillow, and Opendoor. Opendoor also because of Chamath Palihapitiya. I'm a huge fan of that guy. So yeah, I mean, this Redfin, Dropbox, touching on e-commerce, Etsy, right? It's in terms of statistics, stores since March 2020, the statistics of online sales is just less than 20%, which to me is amazing, because over a decade it was 5 to 6, now it's 20%. To me, it's what? It doesn't make sense. Why shouldn't it be 50%, right? So I see a huge scale for e-commerce space, and Etsy is profitable already. The margins are getting good. They have a very good ad model, because their ad model is amazing. They basically the stores or people who are selling products within their platform, they are charging it if they get a successful fee from the ads, right? So the ad model is amazing. And my other one is basically Cheesecake Factory as a recovery play. Yeah. So these are my stocks for US. Yeah.
David, what about you?
Yeah, so I guess let me answer the couple of questions posted by Rondy. Yeah.
Cash versus equity and top foreign holdings.
Yeah, let's tackle the elephant in the room, the glove sector. Yeah. Now, we have always been a strong believer in the glove business of gloves since the beginning. In fact, we started covering top gloves since 2014, way before the pandemic. And even at that time, we are looking at a healthy growth of 8 to 12% on a global demand basis. It's just that 2020 was a unprecedented year for the gloves, so we hence the crazy valuations. But depending on your horizon of investment, right? So assuming you are long-term investors, you definitely cannot ignore the glove sector in your portfolio. Why? Because they are a proxy to healthcare. And gloves is to me, the business is so simple. Why? Because it's disposable. Now, why is this so important? Because You use it once, you can't reuse it, which means it's basically a cash cow, Now, of course, that's really simplifying the business, right? And other things that come into play is basically, the demand, or which will impact the ASP, the average selling price of the gloves. Now, at the moment, we are more taking a careful stance on gloves, simply because we are not certain, or we cannot ascertain the threat of oversupply in the coming 2 years, especially from new Chinese players coming into the market, as well as the third or fourth tier new glove players popping out like mushrooms in Malaysia. I guess you guys are very familiar with this topic. Yeah, but again, for long term wise, so short term is very hard to ascertain what's going to happen. But if you're long term investors, right, you definitely must have gloves in your portfolio, and we will be. Although now we have cleared our glove stocks, we will be coming into this again. And among the top four, we like two, Top Glove, and because of the diversification. But you've got to be careful with one thing about Top Glove, which is the ESG, the environmental, social, and governance. So the S&G right now is a little bit under a lot of pressure because of all the limelight shining on the labor issues, so on and so forth. Now the second glove counter that we really like is Supermax, simply because of the business model. They have always been the OBM, or own brand manufacturing. And the management is very smart. They are actually expanding their manufacturing facilities, not just in Malaysia, but to US, to UK, where they have direct access to the end users. Now, when I say end users, I don't mean consumers. I do mean the healthcare industry or the government agencies that stock up all these strategic resources, we call it. Yeah. So that's a pretty smart move. All right. So moving on. Cash to equity is always a very subjective topic, Rondy. But for myself personally, so we are managing about more than 40 portfolios on our hand. We've got portfolios with, as I think the lowest cash position is about 25% right now, to a highest cash to about 50 to 55%. Now, I agree with Warren that perhaps in the first quarter of 2021, we will see a lot of volatility, especially when the Biden administration is going to be inaugurated in US. So traditionally, if you look at the historical references, when a new Democrat president is inaugurated, normally the markets can be a little bit crazy. Yeah, so we've got to be careful with that. Now, I myself would like to see the cash balance slowly moving towards the 50% range. In the first couple of months of 2021. All right. Then after that, we see what happens. Now, before I go to foreign stocks, maybe I answer a little bit on asset class. Now, for us at Spiral Thinker, we are very conservative, so we only invest in the things that we know. Yeah. So we will miss a lot of things like Bitcoin. In fact, we had an internal we had internal sort of like crash course on Bitcoin, I think sometime in May or April this year. And that time Bitcoin was what, 4K or 5K only, And today it's 27, 28K. Imagine the massive opportunity cost that we missed. But again, it is not our money to make because we simply don't understand, and we do not invest in things that we don't understand. So on foreign stocks, let me maybe just do a quick one. So let me share with you this screen. As I mentioned, we are bullish. So we are very confident that this is the coming of the next super cycle for technology. And our short-term immediate focus will be still revolving around the 5G semiconductor stocks. Now, so if you understand about the 5G, there are a few segments. So as you can see, the blue segment is the infrastructure, where we talk about the fiber optics, the wireless, the networking equipment. Then the consumer devices under mobile, where you need a lot of modems, you need a lot of semiconductors and others. Now, we believe that the infrastructure stocks has actually taken off quite a fair bit. So companies like Avago, Qualcomm, Skyworks, they have gone up quite a fair bit. Now, what we'll be focusing on actually is towards the consumer devices moving forward. So with the recent iPhone 12 such a spectacular sales, right, which beat all the analyst projection, We believe that stocks like Evergo, Qualcomm, Skyworks, Texas Instruments, they are going to benefit even more, right? But beyond that, again, with if I were to amalgate, a couple of investment theses, including 5G, including consumer devices, as well as EV, right? There's one common thesis, a common investment opportunity, which is around surrounding the power management modules. Now, as you know, as we have more and more advanced devices, more advanced equipment, more smarter cars on the road, right? Power management is very important. So in this aspect, there are a lot of companies in US or around the world, that are doing are key players in this segment. So one of them is NXP. NXP, I think, is listed in Nasdaq, right? It's not a very big cap. Market cap is about 11 billion only. 42 billion only. They have a very diversified portfolio, and power management for automobiles is actually their core. So we like this company for this reason. Yeah. So I guess I haven't answered all your questions, Rondy.
Yeah, sure.
Yeah. Perhaps we can pass the mic to Meng Teck.
Hey, thank you. Yeah, interesting. I think like for 5G, the way I'll play is by buying cybersecurity company. I think CrowdStrike will benefit a lot. Whereas the internet is so fast, if I want to hack you, it's even faster. So you want a super strong security. And now, since this year actually there's a lot of cyber hack, so I think it's a accelerating trend. And I like the business model. You cannot cancel. You cannot stop paying me. And I get smarter with more people using it. So yeah. The question is the allocation and the view on rubber glove, and do we buy alternative investment, and then also what's our top pick. So let me share on my personal cash to investment ratio. If I were to share my screen, so this is my portfolio now, total portfolio. My allocation to cash is about 34% now. And in fact, to be honest, I want it to be 0, right? Just that I'm not able to get into the stock that I want at the desired price. When the opportunity arises, I wish to use all this cash. And my style is, because it's a long-term portfolio, right? Maybe some of these like mid-term investment, like NTPM, hibiscus, I may, sell and then use it to buy something else. But the rest, let's say if I buy into Facebook, this is something that after I buy, I won't be timing the market. I won't be like exiting, entering all this, right? So that is a strategy here. And if we go into asking whether rubber glove, as you can see, I don't have any rubber glove shares in my portfolio, because my view is for rubber glove, I treat it more for trading. I mean, no doubt, even if you buy right now this price top glove, I believe it will be profitable to you 5 year, 6 year down the road. No doubt, right? And now it's quite cheap compared to 5 years later. But what kind of return are we talking about per annum return, right? Even if you're profitable, your per annum return buying at the current price, let's say if the ASP goes down, even if my biggest concern with rubber glove is lack of visibility on the ASP 3 years down the road. If you're buying it for the long-term investment, because the ASP, right, makes a huge difference, right? ASP goes up double, not only your revenue double, but your cost stays the same or go up slightly, your profit more than double, right? But if your ASP go back to the previous ASP, even if you double your volume or triple your volume, you may never make the same profit as you make right now. So whatever low PE that you are seeing now, I'm not sure whether it will be the same 2-3 years down the road. And if you want to be conservative, you take the PE ratio compared to the forward PE 2-3 years down the road, then there's a lot of cases of the ASP, high ASP, mid ASP, low ASP, which right now I don't think anyone can give you the answer. So that's why I'm not in to the rubber glove counter now, except maybe, right, some counters that are dropping so much that it's ridiculous, like Riverstone. It's a bit ridiculous now because it's only double the pre-COVID price. Yeah. I mean, like just from the net earning they make in yes, year 2020 and next year, the cash value itself, there must be a big increase, right? It's a bit ridiculous. So when you're buying it at those kind of price, you don't even need a high ASP. Your downside is protected, right? So that's when maybe I will enter again. But again, when you're buying them, what will be the growth rate of the industry? I know there's now, they believe there will be an elevated growth rate, at least double the growth rate than the past. But is a 10% per annum growth rate good enough for you? When you can buy Facebook that is growing 20-30% now, right? All this, yeah. And the price is not trading at a very high valuation, especially with the low interest rate and all this. Yeah, there are regulation, but there are all these risks, but you can look at it. All of them have a risk, but which one is acceptable to you? So that's on rubber glove. My cash position is 30-something%. I hope to be 100% invested, which is why when Warren and David say, next year, early next year, there may be a crash, I'm like super happy, man, right? Because I didn't get in big enough on those tech counters. It's so insignificant, the position. I don't even put it in the Excel. Because actually I have C Limited, CrowdStrike, Square, all this, but we didn't buy in big. Yeah. So moving forward on the alternative investment like Bitcoin, I actually never bought it. And to be honest, people are saying the gold, if Bitcoin replace gold, 4 trillion, how many trillion? And then that's why Bitcoin should be worth 400,000 US dollar. It could happen, right? It could happen, but I don't dare to invest in it because it's just like fiat currency law. If everybody believes, then it's true. So it will be the same thing with Bitcoin. If everybody believes it should be worth 400,000 per Bitcoin, then it will be 400,000 per Bitcoin, right? But that's it. Your upside maybe is what? 20-fold from here. I mean, like it's a lot, but it's a long shot to go to 400,000, and the visibility is also a lot of unclear visibility whether you go to 400,000, which to me is a bit. I mean, like Bitcoin as a currency, who would use this currency? In my opinion, I don't want something. I price this thing at 2 Bitcoin, and then after that, because Bitcoin price go up or go down, then I need to change the price. It's a bit weird for me. But that's it. I may be a stupid guy. Don't understand it. It has been going up a lot, and I'm only watching it. Last one is on my top picks for 2020. As you can see in my portfolio, I'm very bullish on the casino.
Teck, I think you need to share your screen.
Yeah.
We don't see it.
Yeah.
I'm very bullish on the casino, this Naga Corp. In fact, it's about 23% of my portfolio. I thought it's more, maybe I added a little bit more, but I forgot to update here. Yeah, it's about 23% of my portfolio. NTPM wise, this is a position that I'm waiting to go out, right? Thinking when is a better time to harvest. So I'm monitoring it. This may become cash position soon. And I hope to add more to Alibaba and Facebook, as well as E&O. Hibiscus really depends on price because this is very short term. So it's very PA related. Yeah. And maybe truly once I study them more. This is the cannabis counter, which is having super good growth, profitable. I mean, like cannabis counter in general, most of them are losing money. The growth, they say is gonna 10x, but then disappoint you by double. But this one, always beat expectation, always revise upward the guidance, cash flow super good, profit super good. I mean, just the best quality, right? But I haven't studied way more into the thing on the Biden legalization of cannabis. Reason being is because legalization may not always be good for this company, right? Because now a lot of people can come and do. Previously, I believe they are the only major player in Florida. But once you legalize and everybody can cross-tail all these things, I don't know how is the impact going to be. But in Canada, the impact is everybody's profit margin drop and everybody, all these projected growth didn't pan out, right? Because legalization, once it's easily available, the prices drop, people don't want it as much as you think. So actually, I kind of worry that will be the same case with glove, with all these people jumping in. Yeah, but let's see how. Based on the analysis, seems like there won't be an oversupply, but would the ASP maintain here? We don't know. So that will be my sharing on the next year situation.
Okay, thanks, guys. Okay, I think maybe it's perhaps my turn. I mean, personally, for me, on my topics, I'm pretty invested in foreign stocks across Hong Kong and US. But if let's say I would like to pick maybe 3 to 5 picks for foreign stocks, other than the common ones like the Tesla, the Disney, and the sea and whatnot. Perhaps I'm personally bullish on Nagacorp, just like Meng Teck. It's a casino recovery play based in Hong Kong. I think they have recovered a lot even to pre-pandemic level, but the market is still not realizing that yet. That's number one. Number two, of course, is Riverstone. Riverstone in Singapore, again, a glove counter, which I like very much. As Meng Teck mentioned, the recent kind of like crash actually made Riverstone only double in terms of year-to-date percentage, maybe slightly more than double only, which I feel like it's oversold. And not only that, Riverstone also have like the clean room glove, and whether there is vaccine or no vaccine, clean room glove in tandem with the growth of tech industry globally, it should continue to be in demand. Number three, I am actually quite bullish in this small cap Hong Kong stock called PC Partner. I think Meng Teck is also invested there.
Yeah, but not huge. Yeah.
So PC Partner is kind of like a value stock, and it's also a play with regards. If let's say you are kind of like bullish on Nvidia, the stock, and you're bullish on Bitcoin, this is something that you can look into. It's only trading at a single-digit PE, and it's basically a proxy to the strong performance of Nvidia and Bitcoin. Okay, and perhaps lastly, this one is probably a cross between Malaysia and foreign picks, but I like Pentamaster in the Malaysian Bursa setting. I really like Pentamaster, but in terms of when I look into the valuation between the Pentamaster in Malaysia and Pentamaster Hong Kong, I kind of like, I'm a little bit more picky in the sense that I go into the Pentamaster Hong Kong. So I'm investing in the Pentamaster Hong Kong. Maybe, I see David smiling, so maybe we can discuss on that later, David. But
yeah, definitely.
Yeah, I think if you're invested in Pentamaster, you can look into the Pentamaster Hong Kong. It is trading at, I would say, a PE ratio of 13 times of the 2019 earnings right now, Pentamaster Hong Kong, as compared to, say, Pentamaster in Malaysia, which is trading at 42 to 45 times PE of 2019 earnings. Of course, there is always going to be a discount because this is a secondary offering, right? But I don't think that a discount which is more than 200 to 300% is warranted. Yeah.
Actually, I wonder what is the problem. I look at that; it's looking like way too good to be true. What's the problem?
Well, I think because Pentamaster Hong Kong is listed in the Hong Kong Stock Exchange, right? So there could be a discount effect because the entire Hong Kong boss is right now because of the Alibaba issue, and previously it was the strike. So I think there is some sort of perhaps psychological discount effect on the Hong Kong stock market. But that said, as what mentioned by Rondy, right? If you look at the business of Pentamaster, they are definitely one of the tech companies or ATE companies in Malaysia that's going to benefit, in the technology super cycle. Yeah.
Maybe I'll share like the thesis of that because there is just an adoption in 3D sensors between smartphone, right? And 3D sensor is still at the very early adoption stage, and they should grow rapidly over the next 5 years. And Pentamaster can also arguably be a kind of like a recovery stock, I believe, or recovery story, in a sense that the pandemic had actually caused the production and installation delay which causes like a lower sales in the first 9 months of 2020, right? And this is something once the cross border is going to be relaxed, they are going to be able to recognize more and more revenue and stuff like that. And remember that this is just something that I kind of like speculate from the clues that was given prior. And today David kind of like confirmed it. But one of the Pentamaster top client is basically AMS from Switzerland, a leading sensor manufacturing company. And if you guys know about the story of AMS, in 2020, this year in itself, they completed the acquisition of the majority of Osram shares, right? So the combination of this AMS and Osram, and when you kind of like bring together two leaders in the optical technologies, and what they're going to offer the market, it's just going to be insane, lah. And I believe that this is only good news for Pentamaster.
Probably I can add some color to your analysis if you don't mind.
Go ahead, please. It's a very brief.
I'll keep it very brief. So I flash out this a slide on the screen. So hopefully the admin can show the screen. This is a very simple slide on Pentamaster. So you can see that actually traditionally Pentamaster is about 40% of the revenue comes from telecommunications, right? So telecommunications is where you talk about the sensors, the 3D sensors for the phones and so on. But the management has been guiding that they're trying to reduce the exposure to telecommunications and to focus on other higher margin segments like the medical as well as automotive. So as rightly pointed out by Rondy, right? When AMS, which is one of the largest clients for the sensors, right? When they acquire Osram, actually they are also they'll benefit from this synergy into the automotive business as well. In automotive, whether we don't need to talk about fully autonomous, right? Even the new cars or the next couple of years down the road, the cars that you'll be buying, right, will have more sensors and electronic components compared to what we have today. Yeah. So as Spiral Thinker, we also like Pentamaster a lot. Whether it is Malaysia or Hong Kong listing, right, is not very important to us. But moving forward, we believe that if they are able to reduce their exposure on telecommunication segment and focus more on the higher lucrative segments, the automotive and medical, right, this company should do very well. And maybe just to add on to what Rondy shared, other than AMS, right, actually Pentamaster has a very huge, very healthy portfolio of clients, including local companies like Unisem, one of the largest OSAT companies in the world, ASE Group, NOS, TTK, On Semicon, and so on and so forth. Yeah. So Rondy, yeah. So maybe hopefully that adds more color to what you shared just now.
Thank you, David. It definitely adds more conviction. I think I'm very glad that David is here. Sometimes when I'm kind of like needing some sort of information with regards to Malaysian semiconductor names, I always just give David a text. I think
but
just
to clarify, the reason why we know so much is not because of a one-man show. Because I have a 9-man, including myself, a 9-man research in the Spiral Thinker group, and our core is actually in technology and semicon. That's why I'm able to share a lot of information off the top of my head with you every time we have a chat.
Okay, guys. Okay, thanks everybody for this. I think now the timing is about almost 1.5 hours already. Perhaps I would like to just kind of like discuss in the last 15 minutes to half an hour or so. Let's try and keep it like below 2 hours, right? Let's move on into like the local shares. I think that's where all our audience are here today. But maybe perhaps before going and moving into topics in terms of Bursa Malaysia and KLSE, maybe we should just do a window disclaimer that whatever is being shared today, it's not really a buy and sell call. Yeah, it's just purposely it's just for knowledge sharing by everyone. Yeah, so please do your own analysis and yeah, whatnot. It's a disclaimer here, guys. Okay, so yeah, coming back to Bursa Malaysia and KLSE. Warren, maybe let's start with you. What are your topics?
Me. So
I know just now you mentioned about Lagenda and I don't know what else, but yeah.
Okay, so I'm quite bullish on the 5G cycle of Inari because where the cycle, I mean the cycle, not to say it's very clear, but I'm not a pro in that space, but I just see that coming up because where the usage of 5G, the demand for 5G phones, so Inari doing the RF chips will benefit. So that's why Inari will be one of my 2021 picks. But the risk, of course, is there because they're highly dependent on Broadcom. But yeah, Inari will be on my list there. Second is Lagenda because it's a very small company in terms of market cap, but there's room to grow. They are doing residential projects and in fact very sellable projects because it's mostly located in Perak right? Perak and Kedah. Very affordable and it's easy to let go, right? Obviously, it's not for investments for own stay, but their take-up rate is not exciting. But in terms of their book value, their inventory versus their market cap is quite interesting. Quite interesting. Yeah, Lagenda. Yeah, DNO. Okay, DNO is like top one pick in stock bid, right? But DNO obviously because thanks for arranging the meetup with KC. Thanks Rondy for arranging that. I mean we can sort of like see their earnings visibility clearer because of their being an EV bull. They will obviously benefit for that, right? And seeing the EV trend moving forward, yeah, their profitability will definitely grow. So DNO. What else was my picks? Yeah, K Power and SCIB. Although it's quite tricky because 2020, nearly all the companies have already when grown in terms of market cap. Their stock prices have grown already. So it will be quite a challenge to pick 2021, but. K Power and SCIB purely because of their contracts that they already secured. Karim on the helm, right? Karim, the management are basically very adventurous. What else? I think that is it for me. As I mentioned, I focus more on US growth and other companies. So KL for me would be a minimal of my portfolio, but anyway, I just managed to churn out those few. Yeah. Oh, Top Glove.
Do you guys want to talk more about DNO? David and Meng, are you guys bullish on DNO as well?
I am.
Okay, so maybe I go first. DNO, actually, we are bullish. Sorry, we like the automotive story. So whether it's DNO or GHM, right? But because DNO is more hardworking lately to come out do IR, so we tend to get more information, and probably that's explain why there are a lot of more interest in DNO at the moment. But I think during the sessions with Stock Bid by the management, right, one of the key points that I would like to highlight, perhaps some of the Stock Bid members have missed, right, is he talked about SOP, which stands for start of production. Now, if you understand the automotive lighting business, it's not a 1 year or 2 year kind of production contract. Now, once you qualify for a particular module or product for your end user, for your end customer, right, the production will go on, 3, 4, 5 years down the road. Of course, there will be price erosion as volume becomes, as your product life cycle is nearing to the end. But then that is where the new products will come into play as well. So, and during his sharing, actually the management, the MD or CEO, I forgot his name already, he hinted a lot on, a lot of new products are coming online, a lot of SOP. So I guess the visibility of DNO's earnings for the next year will be very strong, and that could explain the reason why the share price rally Yeah, Meng, any points? Any thoughts on this?
No, exactly that. It's he already tell you they are gonna more than double the earning. He never tell but he hinted very, very, very clearly they're gonna more than double the earning, all this, and it's gonna continue to grow, and it's pretty much secure. Just wait for you to produce, unless touch wood their factory kena COVID If not, then the thing should appear. right? It's pretty much like the gloves. And this is a long-term sustainable one.
Yes.
I'm not worried about it suddenly changing, right? The only question is, what's your entry price? Huh?
Yeah. So maybe Rondy, we're talking about what is our general stock pick for 2020 for Malaysia, right? Yeah. So maybe I can share my screen again. Since you already gave the blanket disclaimer for all of us, right? So I don't mind sharing this. Can you see my screen now?
Yes.
This is just some of the core, I would say, the core focus for 2021. As I mentioned already, we are going quite heavy into tech. In 2019, we were probably 40% tech, 60% non-tech. But for 2021, we're pushing towards 50 or 60, even 60% on tech. That's why we have stocks like Unisam. We are looking into stocks like Unisam, MI, VS for EMS, Inari. So Warren mentioned about Inari. This is very interesting because now a lot of people say that the dependency on one big customer for Inari is a risk, but we do see it as as an advantage because this customer is a huge play in this segment. So, but it's good that they recently also diversified into second or even third major clients, including Ostrom, right? Okay. So other than Inari, KSM is a very misunderstood automotive counter. All right. If you have time, please study into this company. JHM again is an alternative to DNO, but they focus more on US market. Ugitech is one of my favorite counters. I'll be a long-term investor for Ugitech since 2011. Then other than that, the non-stack companies the more passive kind of business. We're looking at Timecom, we're looking at Scientech, we're looking at Johor. I think Rondy also is covering Johor quite a fair bit for recently. We like this company, we like the management, we like the direction they're moving into. Petrochemical, as again mentioned by Rondy. By the way, we did not come to this because we discussed about this stock. It just so happened that we talk about the same stocks, right? We believe the petrochemical industry may be nearing towards the bottom, but it's very cyclical, and we have to be very mindful about the supply, especially coming from China. Then, other than that, Tenaga has been hit very badly recently due to the ESG. Post short-term play. I think construction, Ecompa, we like it. Since Mentec and Warren mentioned that they like properties. For for us, we look a little bit for thematic play. We look at construction, but that again depends on the political stability in Malaysia. So that's very important. Now, last but not least, again, in one of our recovery theme play, we like AirAsia because whether the vaccine works or not, it's actually instilling the confidence back into the consumer and back, so that people are dying to travel, especially youngsters, right? Just ask your friends. So there's a lot of pent-up demand or pent-up plans to go traveling. If not overseas, people are happy to travel, in short distance to Sabah, Sarawak, to even neighboring countries, right? So we believe that, as part of these aviation stocks like AirAsia and even airports, right, will benefit from this. Yeah. So, Rondy, I think I've shared more than enough on this. Probably back to you.
Okay, Winter, you got anything? What about your side?
Yeah, this is a very interesting view on AirAsia. Maybe you can, if you have time, you elaborate more, because I buy your story as well. But the thing is, looking at the balance sheet, and because they close down so many parts, right? I think the damage is quite permanent, to them, and I'm not sure whether they can survive until the end of the pandemic.
Yeah, maybe probably I can give you our point of view, right? So you know that the pandemic actually hit all the airlines, right? So in this region, airlines, like it or not, it has to stay because it is an important mode of transportation. And you're looking at the available airlines in Malaysia and around the region, right? There are not many. Okay, if you look at full-fledged service carriers, I think it's going to be hit even worse because of the cost structure, the burn rate. AirAsia, for the good part of the year, right, they have actually more than half their burn rate. So that's good. The balance sheet again, so funding is very important. So they need to make sure that they got enough financing. And probably the next chip on the shoulder is actually AirAsia X, because AirAsia X the business is hit even worse than AirAsia, because when the country's locked down, right, and still in lockdown, you just can't travel overseas, and when more and more countries are not opening their borders, yeah. But that said, if your investment horizon is 2, 3, 5 years down the road, right, we believe again AirAsia is a power to reckon. Again, it's not for everyone, because aviation airlines is a very volatile business to invest in. Yeah, so this just a disclaimer.
All right. Sounds good. Yeah. So for mine, if I have to pick one, because all these I think I already say until very bored. I think.
Pick five.
Pick five.
Pick five. Pick
What is
five.
your portfolio?
Not pick one. Pick five. Okay. Yeah. So if I were to pick five, the first one, the rest won't be so quality lah, because I haven't get in ma. I'll get in the one that I see. Wow, damn good. Then I'll get in ma. So E&O will be one. This is a property counter, right? This is a property counter, E&O. Now, the reason why I go in, and in fact, I'm still going to be adding in. If it drop, I'm more happy. The reason is why, if you look at all the property counters, right, I'm very surprised, because recently I look at the whole property segment. Went to KLC Screener. I go and screen the top 20, 30 biggest market cap counters property. I look at each and every one of their balance sheet. Most of them are in huge danger. Very difficult. They have a lot of inventories. Few years back, you look at a balance sheet, no such thing one, no such inventory one. But now most of them has very big amount of inventory. That's why right now, if you're investing in property, they are giving you 30-40% discount off the market value, because they have to pay their debt. Their current liability is higher than whatever liquid asset they have. E&O is one of those healthy one. Of course, I think there are a few Matrix Concept. There are a few healthier one, but very, very rare. And after looking at the balance sheet, I understand why UEMS and Eco want to merge. But never mind, let's not talk about that later. Got people say bad about Eco. Let's talk about E&O. E&O, they have already cleared the inventory. Of all, they are the only one that is able to clear all their unsold property. Most of it is already cleared, and now they are starting from blank, from blank. They don't have any leftover property to sell. They have, but very little compared to what they have. And if you go to Penang, right, opposite Gurney, which is one of the most prime place in Penang, there is a man-made island. Anyone saw that before? Yeah. 80% of it is owned by E&O. They are the one who fueled it. They're going to launch their first project next year. I think it will be the talk of the town. And that's where, I think I can reap some reward from the share. Because now it's trading at 20 years low, right? Every time it drops to this price, you will have a super bull run. In fact, 400% upside from now to the high. And I think now is the bottom, because clear all inventory, healthy balance sheet, waiting to launch new project. Their project are super high end. Usually the take-up rate is very good. And buying at this price, even if share price don't go up based on their usual dividend, they're getting 6 to 10% a year. So I think the downside limited, upside just right there. I think that's why I'm buying this E&O. Other than that, I'm eyeing Denouse D&O. Why? And O is so famous because visibility. In fact, I think the risk is at what you don't know because Denouse and D&O, we managed to go to investor briefing. We understand where they will be next year, and we know where's the risk, and we can roughly estimate where will be their profit, what will stir things up. So the next question is, what's your entry price only? Because what could be the potential upside, Adima. So that's why these two will be my closely watched counter. You will see that I have Hibiscus. I may consider adding Sabah Dynamic, but these are not a super solid position for me because it really depends on the oil price and people's sentiment. So now we are in, but we may get out in next few months when the price is up and nice. Other than that, as Warren said, most of the companies, the share price already priced in the recovery. So I don't know what else to pick if I didn't manage to go and understand more about them. But one company very interesting, if you are talking about construction, is Kejaya Prospect. Because while I was doing all this case study on the company, I noticed this Kejaya Prospect keep on bagging contracts. And I go and look at their financial, wow, damn good. Share price uptrend look like Nestle, look like just up only. Despite COVID, it was not affected badly. So this could be a very good company. And I may be attending, understanding more about this company soon. So that's very interesting. And when we talk about sector rotation and the speeding up of all the pricing in, share price going up, maybe the still rally already, after this will be construction, then after that will be property, so it could be very fast.
Okay.
Yeah, that's all for me.
Okay, so it's my turn, I guess, right? Yeah, for me personally, I feel like in Malaysia, especially due to Stockbit again, there are so many interesting counters to pick from for next year. Really, there is. Even I was just jotting down. I mean, if you know, we have this kind of like the top 5, the top picks competition for Stockbit. I still don't know what I need to pick, because there are just so many good counters. I'm just putting down my watch list here, and there are like more than 10 to 15. Some of them I'm invested in. Some of them I'm really looking into investing in them as well. But if like really like topics for perhaps next year, I'm still going to vouch for a REIT, which is an industrial REIT, which is Atrium REIT. Atrium REIT, I would say, is my biggest holding in Malaysia right now, and I have been holding this, I think, ever since 2018 or 2009. Yeah, 2018. And the reason why I like Atrium REIT is just that it is very defensive, and it is giving you like about roughly 9 cents of distribution in per annum. So at the current price, that is roughly about 7 to almost 8% of yield. And as everybody know that next year, one of the I believe one of the theme is going to be for those fund managers to chase on yield. And there is no better counters to go for yield rather than the REITs. And I believe Atrium is still going to have more upside because number one, their yield is higher, and number two, there is still growth over there. Yeah. So on the Lumilats takeover that they did, so Atrium is still one of my top pick, I believe. Secondly is definitely DNO, without a doubt. I think I'm extremely bullish on DNO, and this is not only for 2021. I believe I'm going to be investing and stay invested in DNO for years to come. This is a good business run by a good management and a super capable and innovative team, right? And it is at the cusp of being a star of KLSE with sustainable growth, driven mainly by strong demand of global automotive LED, right? So number one, auto vehicle sales recovery is there. Number two, there is a rising LED content per vehicle. Number three, there is a big adoption of LED content in even lower end cars. Last time, maybe only a BMW 7 Series. Right now, I think even in those 1.3 horsepower cars, they have a lot of contents of LED already. Number four, there is an industry shift towards electric vehicle and autonomous cars, and this is only good for DNO. And again, just a quick summary on DNO. Its competitive advantage, right, is that there are I would say 5 to 6 major competitive advantage in DNO. Is that number one, it is a technology owner with a known brand. Like Dominant is actually a known brand in the automotive LED segment. It was sued by Osram, right, a few years back. So that kind of like, that's a testament that it has innovative edge. Number two, there is a high barriers of entry due to the high and stringent requirement of the automotive clients. Number three, as everybody here have mentioned, there is an earnings and order visibility from the design win on various car models. You see, in cars, like for instance, when Casey mentioned that he won some Tesla models, that particular Tesla models, for the duration of their life in the next 5 to 6 or 7 years, they're going to be keep ordering from DNO and Dominant. All right, and then number four is the total addressable market. Right now, they are basically global number four with about 4% of market share. But this total addressable market will be growing at the high double-digit CAGR in the next 5 years. And of course, number five is the capacity. The capacity, it's ready. Management already guided that their new second factory will be fully utilized in the next 4 or 5 years as well, looking at their existing order book. And lastly, I believe that the company is at the very sweet spot of their economies of scale, in a sense that an additional revenue is going to really give them a big jump in terms of their bottom line. So when we talk about valuations, right, I mean, Teck, just now you mentioned about valuations and stuff. Yeah, I do agree that right now the valuation looks expensive. But I believe that number one, DNO will be challenging to reach about 50 million profit this year, full year 2020. I think they'll be challenging 50 million. And it is just going to be a matter of time before they are going to record a 9-digit annual profit in ringgit. So, and at this day and age, I think David will concur with me on this. At this day and age, with valuation given to tech, manufacturing, to high growth companies, right? It's only a matter of time before DNO becomes a 1 billion market cap company.
Yeah.
Yeah.
Okay.
And okay, secondly, I think David mentioned Johotin. I would also agree that is also one of my topics. I think Johotin is a misunderstood and undervalued daily FMCG manufacturer, exporter, and they are trading at the multiples of a tin can manufacturer, right? So if you guys saw some reports that was coming up from TA analysts recently, they did mention that there is an effort of changing their name to reflect the business better. I think this will be key to unlock value in Johotin. Hopefully, it's going to be sooner than later, because Johotin as a consumer stock, I think it is also at a nice sweet spot for a recovery play as well. And just now, Warren mentioned about Lagenda. I know, Meng Teck, you mentioned about E&O, but maybe I urge you to take a look at Lagenda as well. Yeah. So Lagenda is a relatively new property counter. As a matter of fact, I only got to know Lagenda recently because I went to Pangkor Laut for holiday, and on the way to Pangkor Laut, it was in Perak, it was in Setiawan, I saw Lagenda there. It was like so ngam like that, And then I know that some of my Chinese speaking friends, they have been really talking about Lagenda. And so during my vacation, I was kind of like reading up about them a little bit and trying to understand more about their business. And I think if, let's say, your screener, just now you mentioned, right, if your screener have Lagenda in it and just using like their latest quarterly announcement, you're seeing that, one thing that is talking about the property counters in Malaysia, right, is that all of them are almost all of them are at historically lowest PB ratio, right? Or like 5 years or 10 years lowest PB ratio. You talk about from your from even like your Eco World to like your UA development and all that, they are very low. But I think what Lagenda offers is that as what Warren mentioned, it is affordable housing. Number one, all their houses mainly are below 200,000, and number two is the access to loan, because the access to loan is, if I'm not mistaken, around 99%. Means a lot of their clients, a lot of their end users have 99% chance that their loan is going to get accepted. So that is the big plus, right? And basically, because your properties are in these kind of like unique places, your land bank cost is very, very cheap. I think, if I'm not mistaken, it's like one ringgit per meter square or something like that. That is extremely cheap, that's key for like a very, very healthy margin. So you're actually in Lagenda, you're seeing a property counter that is growing, that is actually growing, that is extremely profitable as well in terms of the gross profit margin. It is also, it's developing townships. And if let's say you're kind of like guiding and estimating their profit in year 2021 or something like that, it can easily almost reach about maybe 180 to 200 million, perhaps, if let's say you simply kind of like annualize the latest quarterly result. So that is basically a counter that is trading at about 3 times PE right now. And if we look at it on a fully diluted basis, it's maybe even at only 6 times PE. So yeah, maybe Lagenda is something that you guys can consider. What else? I mean, I do have a bunch of other counters lah, like Denons also. Yes, I agree, Denons. At this price, it's just a bargain. Oh, and I also like the furniture and the wood makers. So I actually like Mieko as well, Mieko and Heavier Board. I think they're at a very good upcycle. I think the wood prices per metric cube is coming back to the high side now, to around 2016 high level. So I think they are bound to post very good profits in 2021. And lastly, if let's say we talk about construction sector, I do like Gamuda as well, because I do believe that this year construction has been taken a big hit. So infrastructure has to get on, like there's a reason why the HSR, even without Singapore, is being approved, right? Because I mean, it has to get rolling, otherwise construction sector is not going to go anywhere. So in terms of infrastructure play, I like Gamuda. And in terms of just another small niche construction play, I like this small counter called TCS. It's a newly IPO counter, TCS. Maybe you guys also can check it out. Of course, I like GDB and all that, but GDB has run out so much, so I had to look into some other alternative, and I found TCS. Recently, there is an announcement where they kind of partnered together with a very good property developer in Setapak, which is called Platinum Victory. So I believe that with this kind of partnership, and where TCS at and the profit guarantee that was given by Platinum Victory, I think next year is going to be also a good time for TCS and the construction sector.
Yeah, Rondy, since you talk about misunderstood stocks, right? I just remembered that I promised you guys a spectacular case study for tonight, which I totally missed during my session just now. So, and interestingly, this is actually currently my largest holding. So there's a disclaimer there. I'm a shareholder, so I'm interested party. Yeah. So actually, this stock is a condom maker. It's the largest condom manufacturer in the world, called Carex. I'm sure a lot of you know this company, right? So without taking too much of the time, since we've got just a couple minutes left, I just want to highlight that since the outgoing Trump administration, right, a lot of funding for government NGOs has actually been deprioritized. As you can see, that actually, if you look at the global consumption of gloves in the world, right, Asia, Latin America is actually still quite okay. The one that's coming down are actually the African continent, Eastern, Southern, West, and Central Africa. So this is a big hit to the demand for these condom. The reason is because these poor countries, they cannot afford to buy condoms. That's why they need to rely on UN agencies like UNAIDS, to actually supply free. So this is a very misunderstood business. Consumers do play an important role, but government agencies is also a major buyer for condoms around the world. Yeah, and with the upcoming Biden administration, we believe that the new administration will actually reinstate a lot of key funding sources for HIV as well as low and middle income countries, especially Africa. And if you believe in this thesis and this trend, right, and Carex being one of the most misunderstood companies for all the wrong reasons, they have been on the downtrend since 2016. They were trading at a high of near to, I think, close to $3, $2.70, I can't remember, to a low of 30 cents this year. Of course, they have rebounded quite a fair bit to about 80 cents, but we still believe that the valuation is very cheap, although the PE is 3,000 times based on historical earnings. So other than condoms, they're also into medical products such as the catheters and these prop covers and so on and so forth, right? But what I want to highlight to you guys, especially to the StockBit members tonight, so it's good that you guys stay towards the end. It's actually the latest development. Now, Carex recently bought the remaining stake in this company called GP, Global Protection Corp, that owns the brands like the one condom brand, and then Atlas Nouveau, which is pretty big in US, right? And if you look at the earnings of this company, right? If you look at this, right, the key financial results for GP, in 2020, the financial year end, the profit after tax is 2.5 million US dollar. So you multiply that by 4, so you're getting about 10 million. And you see the trajectory, right? It's actually going into a very high growth trend. So we believe that the acquisition, 100% acquisition of GP by Carex, right, will actually really help them improve their bottom line. We can't really use the historical references for Carex in this manner, because recently in the past few years they have been hit by lack of funding, as well as some I would say management inefficiency in rolling out the initiatives of turning the business around. So management efficiency in order to roll out all these initiatives is key. Again, for all the wrong reasons, the management has actually disappointed the market time and time again in the past 3 to 4 years. That's why a lot of people do not believe. And that to us is actually a very good opportunity if you can really understand the business. So some of the key catalysts are moving forward for this potential turnaround. So turnaround means it's a very high risk, but if they manage to turn around, the returns are very lucrative. Improving tender markets. This is related to what I mentioned earlier on, funding by the UN as well as other government agencies. Strong OBM markets. They have recently ventured into their own brands, quite successful overseas, but they are trying to gain market shares locally. Diversification of business. Lately they venture into glove manufacturing business. To us, that's a bonus. It's not the main driver. Other than gloves, they're also into hand sanitizer and so on and so forth. Now, but the glove manufacturing business has a very interesting story, because one of their key customers from US is Walmart. And historically, they have been sourcing for gloves for Walmart. They don't produce that time, but they actually source from one of the top 4 players, key producers in Malaysia. I won't name who they are. But now, with the pandemic, Walmart said, hey, why don't, the management said, hey, why don't we make the gloves ourselves, and then we supply directly to Walmart. So there's a very good potential there. Then, with their focus on higher, with the OBM products, their margins will improve. I think previously the margin was as good as 20% net. So we believe that hopefully the management will not disappoint the market again this time round. So, but the disclaimer, we currently, the largest holding for us right now is actually, for non-tech companies, is actually Carex. So there you go, Rondy. Hopefully I don't disappoint your members tonight. Yeah,
Definitely not. Okay, guys, I think it's almost 2 hours, and probably it's a little bit too stretched already. Any last words? Warren, all of you, any last words for everybody? And maybe where can they find you if they would like to follow you as well in StockBit, and maybe in your social media handles and whatnot?
Maybe I start first. So if you still, if you are interested, if you have been following us, right, then you want to follow up on the discussion, you can join me in my discussion on Savvy Investment page. You can find it, I think, at the link below, or just type in SAVWEE on Facebook. You can find it every Monday and Wednesday. I'll do a Facebook Live. Mainly we'll be dissecting on what I learned from the companies when I ask them questions. So you can come and tune in and learn more about companies at those Facebook Live moving forward. How about you, Warren?
Yeah, thank you. So yeah, I mean, my last words are basically just a reminder: focus on longer term investing. Don't just focus on short term growth, especially very important. Diversify your portfolio nicely, right? And if you like our sharing on growth stocks and whatever, you can whatever that we said lah, you can follow us on Academy, right? I think we posted just now, right? We got our page there, the Academy official Instagram, Telegram, and our website. Yeah, you can follow us from there.
Yeah, for us, we have a Facebook page. You can search us Financial Independence Express. A little bit long, so we are also trying to rebrand ourselves. But it's FIXPRESSMY. Now, I will try. I promise, Rondy, I'll try to be more active in StockBit. If you are a StockBit member, you can find me at Alliance Value. VALINV, yeah, so it stands for Value Investor. Yeah, again, I'd like to thank Rondy again for this opportunity tonight. Rondy, back to you.
All right. Thanks, everybody. Again, I think I just need to thank you guys for coming on tonight. What's this? Oh, yeah. Thanks for coming on tonight. It was quite a last-minute arrangement. Yeah, I mean, I think if there is any more further questions from the audience, I know we didn't really take in a lot of Q&A today, but if there are any more questions, or if, let's say, you guys would like to reach all of us personally, you can do it in StockBit as well. I will share with everybody everyone's handle in StockBit, as well as everybody's websites and social handles. So yeah, I mean, 2020, I think it has been a mix, or rather, I mean, everybody has their own story for 2020. But I think what we need to keep in mind is that we should always keep growing and keep learning as an investor and as a trader. And hopefully everybody will have a better 2021 ahead. Yeah. Thanks, everybody. I think that's all for us today.
Thank you very much. Happy
you.
value investing. Yeah, take care, guys.
Take care.
Thanks.